Hey, welcome back. Following the pandemic, the airline industry has been a complete mess. Volatile fuel prices, wars, high interest rates, low demand, labor issues, bankruptcies, you name it. However, all these issues have been pushing the stocks to some of the lowest prices in history, and this could be a very rewarding opportunity if these companies recover. That being said, let's have a look into 4 such companies today. To begin with JetBlue, they are an American low-cost airline company and the stock is down like 80% since 2020. The cash flow is very unstable, as you are about to see with all the other companies, but in good years, maybe in a booming economy, they can produce more than $500 million. For a market cap of around $1.5 billion, that's a very attractive ratio, but we also have to keep in mind that during terrible years, they can lose even 3 times that much. Right now, with fears of a recession on the horizon, it's simply impossible to value this company properly. Ultimately, this is going to be all about the market's perception. If there is a recovery and they become profitable again, this can easily jump 2-3x over time. I mean, if they double, they are back to the level from July, so it's not really impossible. Again, this is very much about the market sentiment, and since the cash flow is impossible to predict, what I can do is maybe see how much they will be able to survive. Financially, the company is not doing that great. They have around $2 billion in current assets, but the current liabilities are around $3.7 billion. Now, this includes around $1.6 billion in something called air traffic liabilities, which is something that's pretty unique to this industry. What it means is basically tickets sold for future flights. If they fulfill them, this liability is gone and is not a problem, but there is always the risk of strikes and bad weather and pandemics and other things that can lead to flights being cancelled. Adjusting for this, the current assets are almost equal to the current liabilities, which is not the best, but they have a lot of real assets that can be used to cover the long-term debt, so it's not really that terrible. Now, JetBlue has a relatively high amount of capex, around $1 billion per year. In general, it's very important to look into why this number may be high. You know, if it is because of constant maintenance, that's not really that good, but if it's because of, let's say, lots of investments and developments, that's a pretty good indicator. Unfortunately, this type of business is inherently high in maintenance capex. Think about it, to expand, you buy more planes. More planes means a higher maintenance cost in the long term, and in this industry you can say we can postpone it a year or two, right? They also have some cost reduction measures, which they expect to bring around $200 million by the end of next year. Ignoring the air traffic liabilities, if they were to sell assets to cover all the long-term liabilities, they would need around $5.5 billion. Discounting this and the current assets and liabilities, since they basically counter each other, we are left with almost $6 billion in assets and zero debt, valued at $1.5 billion. Now, to also be a bit conservative, let's assume that the capex would go down to $600 million after they sell the assets and finish the cost reductions. With this and no profit, they should be able to survive for, let's say, 6 to 8 years. The issue is that we don't know how much these assets can actually produce. Is it a free cash flow of $100 million, $300 million or minus $700? This is a very big unknown, and we also have to take into account the state of the economy. If we get into a bad recession for 3-4 years now, they will probably go bankrupt. I would say that the upside potential with this stock is maybe something like a 4x, but with a lot of risk. A year ago, the company announced that it's going to buy Spirit Airlines, creating one of the biggest low-cost airline companies on the planet. This kind of merger between smaller companies is probably one of the best ways they have to compete with the big 4 in the industry. Now the transaction would value Spirit at around $33.5 per share. They would pay $1.5 in cash in advance, so the final price would be $32 per share plus a 12% dividend. The companies expect to finish this in less than 6 months unless it's blocked by regulators. As I'm recording this, the price just jumped 20%, but there is still a 170% potential profit. What's even more interesting is that if the transaction doesn't go through, JetBlue is going to pay $3.2 per share, which is like a 25% dividend to Spirit. Now, if you buy this today and the deal doesn't go through, let's see what you would be left with on top of this money. The companies are very similar, and funny enough, they even have the same market cap today, although in terms of revenue, Spirit is around half the size of JetBlue. They see the same issues in demand, and the CEO even said that the return to normal that they expected is not here, but they are adapting. The company needs around $300 million per year in capex, and the cash flow is very volatile, like we saw with JetBlue. Now, if the market was to value them like JetBlue, the stock would be at around 7 plus 3.2 in case the transaction doesn't go through, so let's say 10. The current assets are worth around 1.45 billion, while the current liabilities are 1.6 billion, including 430 million in ATLs. The long-term debt and liabilities are worth a bit more than 6 billion, but if you look at the non-current assets, they are not really enough to cover this debt. You know, if they are in trouble, they would probably have to cut the price if they want to sell them. But before JetBlue won the bid to buy them, there were other companies that were interested in an acquisition, so if the JetBlue one doesn't go through, there is always the potential for another one. On the other hand, in a recession they would probably go bust or at least have a terrible time. So the way I see this is, if I buy today, I can either make a 2-3x in half a year, or if the deal doesn't go through, the stock is down like 25% after JetBlue pays them. In the second scenario, I have two options: I can sell and cut my losses, or I can keep them and see where it goes. Honestly, this is a pretty good bet in my opinion, especially if I manage to buy this below 10. Sure, it's not necessarily value investing as I normally do, but it's, you know, a play on acquisitions. Now, another company I was asked to talk about is Southwest. They are much bigger than the previous two, with a market cap of around 14.5 billion, and have actually been reporting some records in operating revenues lately. Despite doing well, this one is also down like 60% from the pre-pandemic levels. Once again, we see a massive impact on the cash flow due to the pandemic, but overall the operating cash flow is much more stable. Lately, they have had some massive capex because they want to expand the fleet and modernize the technology. Because of that, they spent almost 4 billion last year and expect another 4 to 4.5 this year. They have current assets of 14.6 billion and current liabilities of 12.2 billion. Overall, they even have a net cash position of 3.7 billion and a total liquidity of 11.7 billion. So financially they are actually doing well, especially for a company that's in an investing phase and the economy is not really in their favor. Since they are doing well, they also reinstated the dividend in January, paying a yield of around 3%. Now, without these investments, they should produce a free cash flow of around 1.5 to 2 billion. For a market cap of around 14.5 billion, that's a ratio of around 7 to 10, which is normal in the current environment, but if we see a recovery and a change in market sentiment, this should probably double. I'd say that this one is a more stable bet on the industry's recovery because the company itself is in a much better financial shape, despite the stock being below the levels from the lockdowns. And now the final company in today's video is going to be Ryanair. Ryanair is the low-cost option focused on students and young adults in general. We can see that even in their marketing, with a recent strategy where the company basically makes fun of itself by posting memes or commenting on viral videos, being very successful. Being low cost can be seen as an advantage, especially in a time like a recession when people don't have that much money to spend. The main issue with this company is that the market is pretty much aware of these things, which we can see in the stock price being at some of the highest levels it has ever been at. Ryanair is currently number 1 in Europe and is actually doing very well in this market, with a 72% increase in EPS. In many European countries, we see them having a market share of 20, 30 or even 60%. To see the difference between the two markets, they even call it a strong demand right now. They also have plans to reach a fleet of 800 planes by 2034 versus 537 today, which should bring a lot of growth. They have current assets of 5.4 billion euros, which are above the 4.5 billion in current liabilities. The non-current ones sum up to 3.4 billion, while the assets are worth almost 11 billion, so this looks like a very healthy company. The debt maturities are in 2025 and 26, so they should have enough time to get that money, after which they would become basically debt-free. They also plan to bring back a conservative dividend policy, so from a business perspective, Ryanair is doing very well and this is reflected in the stock. Sure, it's not the all-time high, but being even close to that level in the current market is, an achievement in itself. Now, something general to consider, which can be a very big issue, is the competition coming from so many other companies, including state ones that in some cases have, infinite money and won't be allowed to go bankrupt. Competing with a company like this is simply unfair, but what can you do? To be honest, other than Spirit, I probably wouldn't invest in any of these. Maybe Ryanair, but definitely not at this price. The risk of a permanent loss is pretty significant and this is not really fitting my risk and reward profile. I prefer airport companies if I really want exposure to the industry, so let me know if you want me to cover them in another video. Anyway, long term, travel is definitely going to be a growing industry, and managing to buy one of these companies in a time when nobody wants them can lead to some multi-baggers if they recover. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.